Hey, this is Chris back here with you, and we're going to get into pension accounts and taxation and how that kind of interrelates with your ability to pay down your debt and accelerate your debt pay down. And the reason I lump these two together is because so many people are kind of trained to think about this in what I consider a backwards sort of way. And you're going to understand why. So let me just get into it. We're going to start with pensions and then we'll go to taxes and go from there. So let's get going. Okay, so I think one of the most common questions I get, I receive, whether it's in person or via email or on my blog or anything of that nature, one of the most common questions I get is, should I pay off debt or contribute to my qualified plan, my 401k, my 403b, my anything of that nature? And the answer is it's kind of tricky, and there's no cookie cutter answer as to what's right or what's wrong. It really depends on your situation. It depends on how much debt you have, what type of debt you have, how much money you have saved for your future, all that stuff, your own personal position financially. But there are some absolute principles you always want to, that I suggest, and you always want to be positioning yourself in whatever way is going to put you in the best financial position, not necessarily today or tomorrow, but literally 20, 30 years down the road, because that's when it's going to matter. And once again, the whole compounding interest conversation, he who understands it earns it, he who doesn't pays it. And it doesn't make any sense most of the time for people to be contributing to a qualified plan if they have a lot of high interest debt. And I want to walk through a couple of scenarios with you right now that I hear a lot and that I see a lot, and just kind of show you the comparison. So you can see here, line one is contribution or existing debt. So this is just a year by year basis. This is saying this year, if you had $6,000 in a credit card bill, right? If you owed $6,000 on a credit card balance versus if you contributed $6,000 towards your qualified plan, what should you do? Where's the real value there, right? And all this has to be done inside a system, and there are all those caveats that you need to make sure that you're being responsible with how you handle your money. If you pay down your debt, the goal is to not rack that debt back up, obviously, because then it defeats the purpose. But if you operate inside of a system, these principles are absolute, and you need to pay attention to them. So contribution here, contribution versus existing debt, the $6,000. It's saying, okay, that's that. Company match, I'm going to put 0 in for now. I'm going to come back to this. I'll revisit it. If you're receiving a company match on your contribution to your qualified plan, we'll address that for people who are. But let's just say for the person who's not receiving a match, what's your investment rate of return on your qualified plan? 6%. What's the years to project just this year compounding? 30 years is we're looking out 30 years. So 35-year-old down to 65-year-old for retirement age. That's a 30-year period. It could be more, it could be less, but the principle, once again, is the principle. It's absolute. It works every time. I could change this number to whatever, and it's still going to work. The more time that you have, the more imperative it is that you do this right. The withdrawal tax bracket, 25%. Now, I'm going to say that I'm going to leave this at 25%, but you need to understand that if taxes go up, it has a negative effect on the qualified plan, you kind of lose control of that. So, and then the other thing I'm going to do is I'm going to say the effective interest rate on the debt right here, 15%. Once again, that's your credit card debt. That's the average rate for credit card debt. A lot of people have higher than 15%. Some people are lower. Unless you have a special introductory rate of 0, very few people have lower than 6%. I see very, very few people that have less than a 6% credit card rate. Typically, it's 8 to 9 is the lowest I see if you have exceptional credit and you have a great positioning with the bank and a long history with them and so on and so forth. So, moving forward here, let's look at what this looks like. If you were to contribute $6,000 to your qualified plan, your after-tax value, after it gains 6% over that period of time, your after-tax value of that, what you're going to be able to take based on the 25% tax bracket, is $25,846. Now, one thing to think about is most people I talk to think taxes are going up. Why? Because we have a lot of debt going on in this country. We're almost $20 trillion in debt as a nation. Tax revenues have to go up, and therefore taxes across the board have to go up. So if taxes went from 25% to 40%, that 25,000 is now 20,000. So you can see there that by putting your money in your qualified plan, I'm going to talk about this a little more detail in another module, but that tax increase, we'll talk about that on the taxes explanation here on the taxes video, but that has a big to do giving up control of your money by putting it in the qualified plan. Now, the debt balance at interest, right? So if you decided not to pay the debt and you just let that compound at 15%, it could cost you $397,000, almost $400,000 in interest payments over your 30-year period of your life. It's no wonder most people in this country are suffocating right now. It's because compounding interest is working against us. It's working against us as a nation from our federal debt, and it's working against us on the perspective that it's on our household debt, because the longer time goes on, the harder it is to keep up with the compounding interest that's working against us on a household level. If you can realize that and realize, yes, we want to save for our future, but we also need to make sure that we want to save for our future in a debt-free environment. We can't control what the federal government's doing on a national level, but we absolutely can control what we're doing on a personal household level. So in this scenario, you can obviously see it makes absolute sense to take this $6,000, stop contributing to your qualified plan, and take that money, pay taxes on it now. Mind you, if you take the $6,000 in income, you're going to have to pay 25% taxes. 25% of 6,000 is about $4,500. Take that $4,500 and pay it towards your high interest debt, because it makes no sense to not do it. Now, the question is, a lot of people go, well, what if I get a match? What if I get a company match? Well, most people I see get a 50% match. So if you put in 6,000, the company will put in 3,000. Your numbers still are no better. Now your qualified plan after tax value is 38,000 after 30 years. The expense of your debt, literally over that period of time, is astronomical. It adds up. It compounds against you because you have the opportunity cost and everything that goes with it. So once again, it makes no sense to do that. Even if you're getting a match, your first and foremost goal needs to be to eliminate toxic debt. Toxic debt, in my, once again, definition, is any debt that costs you more than you could earn on a guaranteed basis in a fixed account. So once again, if you get 100% company match on your qualified plan, you're still coming up way short compared to what that debt costs you over the long run. Why? Because this scary 15% number right there just is stealing your wealth away from you. So even though it's tempting to contribute to your 401k, to contribute to your qualified plan, you want to make sure that before you do that, you eliminate this high interest debt. Now, once again, that is said with the caveat that once you pay that debt off, you don't go and build that debt back up. You don't go and start putting things back on your credit card. You have to operate inside your own system. And that's where, as you keep following through this course, we're going to teach you how to not just eliminate this debt, but position yourself so you're never going to have to go into debt again. You're going to position yourself in the position of the bank, and you're going to be able to recapture a lot of the expenses that you're paying the bank. You're going to be able to recapture and benefit from that on your own. So I hope that makes sense. It's something to really think about. Once again, when you call or when you connect with us to set up your free consultation, your free cash flow consultation with us here at Life 180, that is something that we can address to see what makes sense for you personally. But it's something that every single person needs to address if you have a qualified plan, especially if you're currently contributing to that qualified plan. All right, so let's talk a little bit about taxes, because even though it may not be the most vital component for you eliminating your debt, it is an extremely important component of you accomplishing your long-term wealth objectives and you operating on a more efficient, effective basis throughout the history of your life and here moving forward. And every single time I ask a person that I'm interviewing or doing work with or trying to help and coach about finances, I ask them, how much are you going to be paying in taxes? What tax rate are you going to be retiring in? And when we talk about the tax rate in which they're going to be retiring in, they say, well, I don't really know what my tax rate's going to be. And because that's the case, and because the reality is that's the only answer, nobody really knows what rate they're going to be in when they retire as far as their tax rate. We need to take a look at history, and we need to take a look at where we are, where we're going, all that stuff, and make those decisions, make our decisions with a clear perspective and with factual information. And that's what I want to do for you here, is show you some real information, helping you guide towards a better decision. Now, I'm going to go through here. You can see the reason we have this map up is because, as you remember probably from one of my intro videos, we talked about the history of money and the institution of the Federal Reserve in 1913. That was really huge. Now, there was a senator on the floor when they created the Federal Reserve Act, and he actually filibustered, saying that he could see a day when the government got out of control and had taxes reach 20%. Well, everybody kind of laughed him off the floor, but the reality is, within 3 years, taxes were up to 15%, and within 4 years, taxes were up to 67%. Now, you can see here that they're really only going after the Warren Buffetts of the world, because back then, $2 million was really almost $100 million a year in income in today's dollars. So that's going after the upper echelon of people. Why did they have to do that? Well, we were getting into World War I, and we knew that, right? World War I was coming. How do you pay for a war? You pay for it with taxes, and so on and so forth. Well, we got through that. We had the booming 20s. Things were going awesome. They seemed to be going awesome. A lot of speculation. A lot of things got out of control. But you could see taxes now got over 25% on $100,000 of income. So they're ranging all over the place. Now, I'm not going to spend a lot of time going through case after case, but what happens in the world, Great Depression to World War II to going off the gold standard, Vietnam, and Reagan coming in, and the Gulf War. We have all these wars, we have all these taxes to pay to cover all these things. The reality is we've been living in the lowest tax rate environment that we've seen pretty much long term in the history of this country since the institution of the Federal Reserve. And when you look at how people make decisions and funding pensions and saving for retirement and deferring taxes till later, and that's why IRAs and all these tax deferred accumulation vehicles that people invest with their mutual funds and stocks and so on and so forth, that's why they're so popular, because people are trying to reduce their taxes. But my question to you is, why do people want to do that? Why are people looking to reduce their tax liability in the lowest tax environment we've ever been in, yet everybody says taxes are going up? 99% of the people I talk to, that's actually an understatement, virtually every person I've ever talked to in my life right now in coaching thinks taxes are going to be higher at a later point in their life than they are today. So if that's the case, why are we trying to defer taxes? Because you will have to pay taxes on that money eventually. There are very few things in this world that give you pure tax deductions. Your mortgage is one of those things. So that's why I actually like mortgage debt. If you're going to have debt, I want you to have enough money saved to pay off the mortgage, but I want you to have, I like the mortgage debt, I should say. So you can look at this. Let's look at the averages. The long-term average, the historical average since the institution of the Federal Reserve is 58.43%. That's 58% of mortgage, or of 58% is the average tax rate that people have paid over the last 100-something years. And if you look, that just tells you taxes have to go up, because we've been living in this low tax rate environment. And in this period of time, if you look at the debt numbers from 1980 to today, our debt has gone out of control. And so we actually we're in more debt per capita than we've ever been in the history of this country, ever. And so we have to make up for our blunder, and we have to raise taxes. And if you know anything about averages, these numbers, tax numbers, have to go higher now to compensate for our low numbers over a long period of time. And if that's the case, we need to make sure that we're paying taxes today at a lower rate to have access later. Now, a lot of people say, well, it only hits the top 1%. Well, I want to kind of show you something and go through this. You can see here, there's the initial rate is 1%. So people start paying 1% off the initial threshold. And then here's the top rate at the top threshold. And obviously there's brackets in between all this, but you can see that it's not just the 1% that taxes go up on. Yeah, the upper 1% pay their fair share, but even the middle class will wind up paying a substantial amount in extra taxes. You can see here the initial rate in 1944 went up to 23%, 10%, all the way from 1940, 4.4% to 23% over a 4-year period on low income. This is your average middle class. So nobody, this is where we are in this world right now. Taxes have to go up. And if anybody thinks that they're just going to be able to go after the 1%, it's delusion. It's pure delusion. Everybody's going to be paying more taxes. So why are people deferring when they could do it today, and when they could pay the tax liability today? Because you're not getting out of it. All you're doing when you defer paying taxes into those accounts is giving control to the government, because the government knows how much money is in all those accounts. So they know if they need to raise a certain amount of tax revenue, all they have to do is change the tax regulations on your 401k, on your IRA, on your 403b, on any of those accounts, and bang, your wealth can be swiped away from you. And let's talk about what that looks like for a second, because right now, let's say you had $100,000 in an account and you're in a 0% tax rate. Well, nobody is in that, but anytime, let's say you're up here and you're in a 10% tax rate. Well, that means if you have $100,000, that means $90,000 of that is the government's and $10,000 of it is yours. Well, guess what? As soon as your tax rate goes up to $35,000, all of a sudden $35,000 goes to the government and $65,000 goes to you. So what just happened there? The government just stole $25,000 from you. I can't say steal because they did it legally, but the bottom line is they regulated your money away from you. And that is my problem. And that is everything I teach people, everything that people need to understand is making sure you keep your money liquid. You need access to it, making sure you have access to it and you have control over that money, and making sure that money is beating inflation. That is how you're going to get where you want to go. And avoiding paying unnecessary taxes over your lifetime is going to have almost as much an impact in your ability to create wealth as anything else you do, because I think we're going to have a generation here that have a lot of money in their retirement accounts, but the government is going to have complete ability and capacity to just regulate that money away from them. I don't mean that to sound conspiracy theorist, but if you look at history, it happens all the time. The difference is up until 1981, when people started doing this and putting money into their 401ks, it didn't really matter. It didn't affect. People didn't have their money saved in the same ways. So what I'm talking about is showing people throwback style plans where people thrived and succeeded even in these nasty high tax environments. How is it we had such high taxes and we were, in a better situation? We could have one person working and a stay-at-home parent and all that stuff. Well, it's because we didn't have the debt load that we had back. We didn't have the debt load back then that we have now, and people were actually just living and saving in a more effective, efficient way, because they were just, the way that you manage and structure your financial life is a completely different thing. And that really comes down to the financial pyramid that I'm going to be teaching. And so that's a future module that you're going to see in this course, and it's going to be really exciting. When you start plugging all this stuff together, it starts to make a lot of sense. And so that is why it's so important for the taxes. I hope that makes sense. Once again, you can email us, roadmap@life180.com. I'm happy to help you out, or chris@life180.com. Happy to help you out, answer any questions you have, and we'll go from there. Now that you have more of an understanding about how funding your pension works, and the fact that you're not really getting a tax deduction, you're getting a tax deferral, and how the taxes work and how taxes are most likely going up, and it doesn't make much sense. Granted, if you're getting a contribution, a match from your employer, it can make a lot of sense. However, if you have a lot of toxic debt, I've shown you that it doesn't make any sense to contribute to your pension plan. You want to reallocate that money and you want to pay down your toxic debt. And then once you pay down your toxic debt and you get a hold of your financial life in that capacity, then you can recontinue the contributions to that pension plan. But I just want to make sure you put all of this information into your exploration questionnaire that comes with this module. Put all this information in one place together, then you can move forward. Until next video, live abundantly, live efficiently, live Life 180.